Hello, everyone, and welcome to our webinar, From Earned Real Estate Income to Passive Cash Flow, Using Passive Income to Fund Retirement. I'm Melissa Lutz, the Programming and Events Manager for RLI, and I'll be your host today. The Realtors Land Institute, the Voice of Land, continually strives to maintain its status as the acknowledged leader for all matters pertaining to the land real estate professional. RLI endeavors to remain the essential membership organization for the extraordinary real estate professionals who broker, lease, sell, develop, and manage our most precious resource, the land. We're here to provide our members with expertise, camaraderie, and resources that are the foundation for all land real estate professionals to become the best in the business. While this webinar does not count as credit towards RLI's elite accredited land consultant designation, it is filled with valuable expertise. During today's webinar, Rich Azaga, the Real Estate Whisperer Financial Planning, is going to discuss ways to unlock the power of your earned income and transform it into lasting wealth. This dynamic webinar is designed specifically for realtors who want to think beyond the next transaction and build true real estate, build true financial security, both within and outside the world of real estate. He'll touch on where to invest your earnings for maximum long-term impact and learn smart strategies to grow your wealth through real estate, traditional investments, and retirement planning, especially tailored for self-employed professionals. Rich is a CFP and a CCIM. He is a rare blend of certified professional planner and investment real estate expert, uniquely qualified with the top designation in commercial real estate. As founder of Real Estate Whisperer Financial Planning, Rich specializes in helping real estate investors and their advisors navigate complex decisions, including buy, sell, hold strategies, cash flow modeling, 1031 exchanges, and advanced tax strategies. A sought-after speaker and honored instructor in UC Berkeley's personal financial planning program, Rich's insights have been featured in Kiplinger, the Wall Street Journal, Newsweek, Real Estate Business, and other leading publications. Feel free to type your questions in the chat box throughout the presentation, and we'll answer as many of those as we can. Please give Rich a warm welcome.
Alrighty, Melissa, thank you for allowing me to present, and thank you for hosting this. I appreciate that very much. Hi, folks. My name is Rich Arzaga, and as Melissa said, I am a certified financial planner. I'm also a CCIM. So it might sound kind of weird to be both on the real estate side and the financial planning side, but my core business is financial planning. It is helping folks like you get in the right direction to be able to declare at one point in your life financial independence. So you never have to worry about working another day in your life unless you want to. The CCIM reference or the designation is, I was a broker many years ago, but more importantly, a lot of my clients are folks in the business or folks that own income property. And that's what makes us very unique because there's not a lot of advisors out there who enjoy talking to clients about their rental properties or directly held real estate. So that's what makes this mix a little bit more interesting and maybe useful for you. I saw a couple things I want to ask. First of all, I want to ask you to ask any questions you have during this presentation. You're not interrupting me. I will check chat to see what the questions are. So please leave them on chat. And I will take them as we go. So let's make the most out of this time together. There's not a lot of folks. There's enough for us to be able to get you involved and get your questions answered. So this is all freebies. Please ask that question. Second thing, and we have just about a dozen attendees or so, but let me know on chat, what age are you? And you're not seen, so you can give your exact age. You can go ahead and bluff it a bit, but we got one at 61, we got 36, 39 years old. This will actually help me understand where you're coming from and maybe how to better aim this. 46, 65, 44. So basically, tight late 30s to mid 60s or so, a couple more 40s coming in. That's excellent. Okay, folks, that's exactly what I was hoping to get here. So here we go. And by the way, I really know what I'm doing, so please ask. I'm here to help you. This is a service to you. I've been teaching other financial planners for 19 years now, and I'd love to help you out today. Okay, so here we go. First, a disclaimer. These are opinions only. These are concepts only. Anything about taxes, it'll be talked about on a federal basis because state income taxes are all very different. This is meant for guidance. That's what this is all about. Um, what what this is not meant for is for you to go out and actually do something based on what we talked about in this workshop, because you probably need to drill down a little bit more than just attending this workshop to see if some of these ideas are suitable for you. So just a heads up on that. Don't go out and do something right away, but use this as a launching pad to figure out what's going to be right for you. Here's what our outline looks like. We're going to cover some very basic principles, some key principles in personal finance. We're going to talk about a little bit about some opportunities that exist in your field, being realtors and doing what you do, being independent contractors for the most part. Then we're going to talk about, like a lot of the description said, turning this into, maybe some investments that provide lifetime income. Because right now you're working very hard, you're earning the income, it's coming in, you're being taxed on it. Ideally, you're saving a little bit every year and you're investing in yourself a little bit every year, and it's going to pile up over time. And at some point, you stop working. Either that's voluntarily or it's involuntarily. It's interesting, most people are involuntarily retired, more than half. So it actually can happen that way. But at that point, that's when you have to turn all of this hard work into income to yourself. And we're going to talk about some different ways to do that. And then we're going to talk a little bit about planning and the idea that you need to start planning today. It's never too late, whether you're in your 60s or in your 30s. It's never too late. I've seen wonderful things happen in a short period of time. So, I mean, my hope for you is to put this in your mind as you go through this workshop. What if your final closing gift to yourself was passive income for life? Because that's essentially what will happen. Most of us will live a pretty long life, longer than we think, and we don't need to make sure to take care of ourselves for that time. Let's see. Just checking chat here. Make sure that everything's okay. Great. Thank you for a few more answers on that age. Okay, so why is it important? And I know this is a busy slide. I've got a couple of busy slides here, and I'm going to do what I can to make them as easy as possible interpretate. So, and, let me do this. Out of these four different ideas right here, I'm going to pick on this one right here in blue. Okay. And this is today. This is if you are 65 today, and some of you are, and most of you are not, but it gives you an idea. If you're 65 years old today, what is the chance, if you're a couple and retiring as a couple, what is the chance of one out of two of you living a longer life? So let me show you what that means. Uh, this is at least one couple living to a certain age. And if you're 65 today, when you're at the age of 85, there's a 90% chance that at least one of you will live till 85. Now, if I asked you probably, in the very beginning before I showed you this chart, what do you think your life expectancy is? Generally, I get, oh, it's in my maybe late 70s. My parents passed away when they were in their 70s or 80s, probably in the 80s. And well, believe it or not, there's a very good chance at least one of you, 90% chance out of 100, that one of you will live till 85. Now, check this out here. There is a 73% chance that one of you will live till age 90. So that's probably surprising. And even more surprising here is, what's the chance of at least one of the two of you living till 95? It's 43%. So that, and then finally to 100, this is outrageous. And it keeps growing every year because medicine keeps keeping us alive, whether we should be or not, right? There's a 15% chance that one of you will live until age 100. So that's amazing. Now, what are the colors about the light blue and the dark blue? Well, if you're healthy, if you're in good health and you don't smoke, this is what it looks like for you, the 90%. But if you do smoke, your chances are reduced to 71%. This is the smoking factor right here in each of these different bands here. That smoking does have an impact. I'm not creating a judgment on this. I'm just saying that if you want to look at yourself and take a look at maybe if you smoke or not, this will help you a little bit understand what that looks like. And by the way, if you're single, and if you're a woman, here's charts for you. And if you're a man, here's a chart for you. The message here, the point here is that there's a very good chance that you will need to provide for one of two of you, the surviving spouse, and for their long life expectancy. So think about that. You work till 65, you probably have another 30 years to live at least till 95, and you need to afford to be able to fund that because most people want, what most people really want, and this is one of the top fears that we have, as families, as individuals, as investors, is we fear running out of money and being forced to knock on our kid's door and asking for help, or being reliant on the government, which is actually getting harder and harder nowadays. So that's what the point is on this. It starts with very small seeds, and contributions today can create a big harvest in the future. A little saved today can grow a lot tomorrow, just like planting a single seed can someday yield an orchard. And that's what that point means. So here's another busy chart. I've got a couple of them, but I'm going to try to simplify this. Let's just focus on blue for a moment right here. We're going to focus on this one because it's probably the easiest. Now, this makes a couple of assumptions. First of all, it assumes that somebody starts at the age of 25, and we're all past that at this point, right? So I understand we're somewhere from here to here. But let's assume this is an illustration, this is a point that we start at age 25. And let's assume that we retire at age 65. And this is a really good assumption to make right here. This is an easy one for all of us. Let's assume that our starting salary at 25 is $50,000. Very doable for many of us. In fact, many of you are well beyond that. If you're well beyond that, you can multiply that. But the outcome, just to give you an idea what this could look like for you. And let's assume kind of conservatively that our wages grow by 2.5%, almost 2.5% a year. Here's a harder one because this is a chart that was given to me. But let's assume there's an employer match of up to 5% of whatever you contribute. Now, you don't have employers, you're funding your own retirement, you're funding your own savings. I understand that. So you just got to assume, well, I want to go ahead and assume that I'm going to fund 5% more. So in addition to contributing, this is the blue line right here, 3% of your income of $50,000 at 25, you're going to add the other 5% there because you got to make up for that employer match because you are your own employer. And it assumes that the investments grow at 7.25% a year. Is that possible? Absolutely. 7.25% a year long term over the last 40 years has been about, it's like buying 70% stocks and 30% bonds, something like that. So it's very possible. It's a pretty responsible assumption, even though it may not feel like it. For 20 to 40 years, this is a pretty decent number to use. Well, if I did all that stuff, if I started at 25 and saved 8% a year, including my own employer match, and if I let it grow, if I just did that only 3% plus the 5, which is 8%, till 65, I would end up right here with $930,000 at the very end of that. So that's over $1 million. So you want to know what takes to become a millionaire? This is a very good idea what it takes to become a millionaire. Now let's kind of scale that up just a little bit, by the way. Let's assume that in addition to the 3% contribution, we're going to go to the green line. We're going to increase that contribution just by 1% a year until we get to 10%. So if we just make that little contribution and get it to 10% a year, right about here, it scales all, and we keep it that way. We make contributions every year, a little bit every year. It scales all the way up to here. And at that point, because of the extra contributions you've made, it gets you to $2.1 million. And I could tell you that $2.1 million at retirement, assume that you draw out 4% a year, that's going to give you about $85,000 a year income, not including your Social Security. So that's a pretty darn good start. And by the way, most people that retire at 65, the average spending is less than that in the United States. I know some of you lived in the West Coast or the East Coast where it's more expensive, so you have to scale accordingly. but that gives you an idea what that looks like. I won't go into the purple one. You can look at this later. We will make this slide deck available for you along with a recording afterwards. Melissa will make that happen for you. But I just want to let you know that it's really important to start early and do what you can, and even small amounts of contributions can help. So I want to make this one a lot briefer. I know there's a lot of words in here, but let's focus on the colors here. And the question is, what are the different ways that I can save? And by the way, where should I start first? Well, I'm going to answer that next one on the next slide. Where should I start first? And then where do I go next? And that sort of thing. Kind of gives you a roadmap of what to do. But here's the different places where you can save money, all the way from IRA accounts and retirement accounts that go in before taxes. And so you get a tax deduction on your income for that year that it goes in, all the way to taxable accounts like your Schwab, your Fidelity, if you work with a broker, all those types of accounts that are taxed whenever there's dividends taken or there's growth realized. And then there's the Roth accounts. There's either Roth 401ks or Roth IRAs where you put in money after taxes. If you're qualified income wise or you want to do a conversion, that money goes in after taxes and it grows tax free and it comes out tax free. This is like one of the holy grails of where to put money in for most people. If they can put as much as they can in the Roth and make everything else work, that's where most people want to go. It's a good idea for many of you. And then there's something that's emerging more. It's becoming a really good idea. It's a health savings account. If you qualify for it, it's a good way to put extra money in. It's like a Roth. It's like a Roth contribution, except you actually get to write off the amount that you put in if you qualify for that. So check that out at some point. We won't go into details on that right now, but these are the different places where money goes for you long term. I will talk about real estate. I will talk about self-directed IRAs, by the way, because I don't want to leave that out, because I think that's a big opportunity for you. But just to give you an idea, here's an extra chart right here that I added, and this is what the taxability is. Our income tax is owed when the money is pooled. Like I said, on these two, they're not. On these, they are on most of them. And then is Social Security is that is it accounted against Social Security taxation, and this gives you that as well. So I hope this chart is going to be very helpful to you, but this gives you an idea where the money goes in. Now, how should you consider, and this is not for everybody, but this is for many of you, what is the sequence? Where do you fund first? That's one of the most popular questions I get for people, even if they're experienced, if they got money. Where do I put the next pile of money that I get in from the next check that I get from a sale that I just made? Well, start right here. This is by prioritizing. This is from number one all the way to number eight. Okay. And the very first thing you want to do is fund an emergency fund. So in case something happens to you and you're not able to work for a period of time, or there's a recession, the market is slow, that sort of thing, you have somewhere to pull money from. Now, in the old days, the emergency funds, the rainy day bank accounts, right? They used to be from putting aside 20, 40, $100,000. When you get older, maybe a $200,000 for long-term care. They used to be about putting that money away into a savings account and making it very conservative. Nowadays, in the last 15, 20 years or so, since I've been advising people, um, there's actually not a lot of actual use of an emergency fund. When it happens, it normally is a roof or something like that. Maybe it's unemployment for 2 months, slow market for 6 months, but there's not a big use of it. So you've got all that money sitting there. So nowadays, an emergency fund could also be like a home equity line of credit. That would be a very good way to have an emergency fund available without having to put money just in savings and watching it grow at 1 or 2% a year. If you work hard enough, you can actually get 3 or 4% a year interest in today's marketplace, but that goes up and down, right? If you have a home equity line of credit, if you have a securities backed line of credit, which is the same thing, except instead of a home, it's against stocks. If you have a HELOC, I'm sorry, if you have a reverse mortgage, there's some things about reverse mortgage that are good, and there's some things that you need to be aware of. but that could be if you have one outstanding there and you're older, over 62, that could be another form of an emergency fund as well. And then you get into number two is your retirement accounts. And you want to go and fund as much as you can up until the match. If you get an employer match, which I know most of you don't, you match yourself, which is great. You want to get to that match. And then after that, you want to pay down higher interest rate loans. Comes up a lot. What should I do with the debt that I have? Well, the number here, maybe the feel good number is if you're at stage three and you've got your emergency fund figured out and you're contributing to your 401k all the way to get to the most, the max, maybe the rule of thumb here is, hey, if it's about 7.25%, then and it's over that. If my interest rate is over, like credit cards are at 19%, 25%, crazy things like that. Personal line of credit might be at 12%. If it's over 7.25%, pay that down at this point because at that point, it's just costing you more money than you're earning in your accounts, like the previous illustration that we saw. Then number four and five, max out when you can your health savings account if you're eligible for that. And if you have any questions afterwards on any of this stuff, feel free to reach out to me. I'm really happy to help out. Happy to have our conversation be at no charge just to get you in the right direction. But the health savings account is a good way to do that. And also additional contributions to your 401k or your IRA account. So there's that. Then you pay down number six, the lower interest rate loans, do additional IRAs, maybe backdoor IRAs, Roth IRAs, and then taxable accounts. So for most folks, this sequence here in terms of where to save money should do the trick. Ask your advisor, ask your tax person. These are best practices. Feel free to reach out to me if you'd like to ask a few questions on your own. Okay, so you already have the expertise in what you do. And by the way, I did what you did for a couple of years back in the 90s. I still proudly have my broker's license, but I haven't transacted a third party transaction since 93. So I really respect that what you do. I know what you do. It's a lot of hard work. But you have the expertise in this. Consider putting it to work for your own legacy. And so there's some things about what you do that are kind of interesting. I think a lot of what you do is interesting, but there's some things around financial planning and savings. This is a busy chart. I'm not going to expect us to go through this. But if you look at the two columns here, this is 2025 right here, the second column. This is last year. And this is retirement plan contributions. And these are all the different plans and the different ways that they can, impact you. And here's the limits for 2025. But I'll make this really easy for you. And by the way, I will make sure that there's a full version of this on the slides, the PDF that you get. But here's an easier way to look at this. Depends on your age. By the way, if you're in your 60s and you're in your early 60s, and also if you're over 50, and I know there's a lot of different, kind of nuances to this. They don't make it very easy, Congress. But generally, to create a 401k for yourself, and you can do that. You can create one all on your own, a self-directed 401k, or you can work with a broker to do this. But you can generally put away between 23,500 to 30, almost $35,000 a year, depending on your age. If you're over 50, if you're 63, 64, there's some bump ups like that. So that's what that range looks like. Probably one of the top questions I get is, actually, what top concern I get is I'm paying too much taxes. I like to put more away in a retirement account to help me, reduce the taxes. And most of the time, most people are not maxing them out because they're not really sure what the maximum is. And so this is what the maximum is 2025. It'll change every year slightly. There'll be something that Congress does that'll kind of turn us on a side that'll be better for perhaps. Normally, it's not worse in terms of savings. So take a look, be aware that this will change, but normally for the better. But this is what you can contribute to. By the way, if you add a profit sharing component to that, which you can do, it's a little bit harder, a ton bit more work, but it's definitely worth it. Then many of you can put up to, especially if you're older, up to $70,000 a year. So if you didn't know that before, if you thought you were capped out at 25,000, 28,000, something like that. These numbers might help you a lot. For those of you who are really dialing into this, you probably recognize these numbers. For those of you who are not, there's a lot of opportunity for to be able to save here. So the way to look at this is this: for every $10,000 you can put away today, more, it'll save you $3,000 in taxes today, roughly, um, for taxes, income taxes, and it'll certainly compound like that chart showed you earlier in 10 or 20 years. I mean, plan for that 10,000. Again, if you're a reasonable investor, you're well behaved, plan for that $10,000 to double every 10 or 12 years, roughly, at that 7.5% or 7.25% return rate. Here's a SEP IRA, by the way. Those are a little bit easier to administer, a little less complicated, a little less flexibility. Again, your advisor or somebody who's helping you set this up can help you understand that, the nuances. But that's also up to $70,000 a year. So there's that. And there's reasons for one or the other, by the way. I won't go into the details now. Now, here's the one that's normally a very big surprise. There's a few of you out there that might be really raking in the income. And if you're over 50 years old, this is where it really helps. There's these cash balance plans that allow you to put $280,000 or more away every single year. So this is this is a great thing for realtors, self-employed. If you have no employees, or if you have a spouse that's that's your coworker, um, or you have a very young assistant, um, putting away 280, it's possible. You can do if you're having a very big year, a $500,000 a year, $1 million a year. I know not everyone does, but some people do, and some people do it consistently. They can shield a lot of that from taxes, up to $280,000 in something called a cash balance plan. In fact, you can see it down here, defined benefit plan. That's another term for that. It's 275, it's 280 this year. That goes up every year. And I can tell you there's exceptions so that if you limit the number of years you contribute, you can actually put in more. So we've done a lot of these for our small business owners and real estate professionals, and it's worked out very, very well. Because when they pull the money out in the future, they're not earning the income that they were earning that earlier when they earned that. So they're not being taxed to death, and they can pull it out in whatever increments they want. They don't have to pull out the 280 in any given year. They can pull out 75,000 and really manage their taxes from the retirement savings. Very exciting chance to do that being in your business. Here's the other main thing being in your business that could be of help. So you probably have heard of the term self-directed IRA accounts. Well, so those are called SDIRA, self-directed IRAs. And self-directed IRAs, typically what you do is you go, like for example, when you go to a Schwab and you open up the account yourself, and you don't have an advisor in the middle, you're making the selections, that's self-directed because you actually open that yourself and you're directing your own investments. So most of these self-directed IRAs deal only in traditional securities like a Schwab or Fidelity, in the old days, TD Ameritrade, E-Trade, that sort of thing. But the second point down here is there are a few of these SDIRAs that offer you to hold real estate in there. So you can actually buy a piece of land, you can buy a rental property, you can buy a fourplex, you can buy an apartment complex. I mean, it can go up from there, but you can buy real estate in there, and actually own it in your IRA account. There's some pluses and minuses to that. I think there's being in your industry, there's a lot of pluses to that probably if you really know what you're doing and you understand what you're buying, how the cash flow works. Maybe it's land banking. I don't know, but if you understand how that works, it could be a very good thing for you. You lose some of the tax benefits that you get in owning real estate outside of a self-directed IRA account. You can also do that with notes. So I had this one client that had $300,000 in notes that they're lending out. And what we found out was that because they're already making so much income, the note was being added on top of that income and was being charged at ordinary income tax rates. And they're in California, so they're paying almost 50%. So out of the money they were getting, they were paying half that from the note. We moved that, we were able to kind of switch that out and move that note into an IRA account. And now they are able to bank that entire amount without paying taxes. And they will only pay taxes when they withdraw that money. Private equity is another one. But anyway, you can transfer, you can open up your IRA accounts after directed and do this on your own. I want to show you that here's the different types of accounts. There's a self-directed IRA, inherited IRA accounts, solo 401ks. So it's not just limited to IRA accounts. And by the way, you can also open self-directed Roth accounts, inherited Roths, solo Roth 401ks, and of course, the Roth 401k, you can do that too. If you're saving in your business, you have a SEP IRA account that could be a solo account. So can a simple account. So you can do a lot with this. And by the way, I will tell you, and I don't mean to confuse things, but if you're saving for somebody's college, whether it be your children, maybe your own education down the road, um, or maybe your grandchildren, then you can do a Coverdale and make that self-directed. And the HSA, the health savings account that I boasted about earlier, those could be self-directed too. In fact, I'm a financial planner. I only do plans. I don't manage money, which is kind of nice. I have folks to refer off to, or I work with my clients' existing investment folks. But I do my own health-directed HSA, self-directed, and it's pretty easy to do. So I'm checking chat. I want to encourage you to ask any questions that you have. I don't see any yet, so I'm going to continue on. And finally, one last whack at the self-directed IRAs regarding real estate. Here's the different types of real estate that I've seen purchased using self-directed IRA accounts. Residential rental properties, apartments, other commercial. I see that. Uh, I see the first two. I see the first one often. The next two, apartments and other commercial, less often because it normally requires a lot of capital. But I've seen the ones below that quite often, actually. And there's some people that do nothing but that. So the kind of one of the knocks on self-corrected IRAs holding real estate assets in there is, gee, Rich, I thought you needed a lot of money to be able to make that happen. And on the ones that are starred, there's ways to do that for a lot less money. I've seen people really go to town on a $20,000 self-corrected Roth account and begin doing some of the ones that are require less capital for real estate and begin to be fairly active on that. I'm not suggesting you change your career and you do this at all. I'm suggesting that it could be a real good complement to some of the things that you do right now. And maybe some of that is around some of the earnings that you generate from a transaction and being able to use some of that if you can afford that with the cash flow, maybe use some of that for self-directed IRA accounts. So I think the combination of you can put a lot away every year if you're able to on a household cash flow basis, and if you want to, and then if you want to buy real estate with that, there's a very good opportunity for what you do to be able to accomplish that. Well, I hope that helps a little bit with some things that are specific to you. Now, some more things that are specific to you around when you get closer to financial independence, you begin to think, how exactly does this work? Because that's a very popular question is, how does this work? And the answer to that is it works based on what you've got, based on what you currently set up for yourself. But just to give you an idea what you're aiming for, because remember, you're replacing your earned income that you generated while you were working into passive income in the future that is, based on all of the wealth that you have built over time. So, what are the assets that will free you, that will help you replace your income when you're in that position? Okay, so you're going to see the form of this slide twice, but let me tell you, when we normally folks really get hopefully you'll get serious about planning sooner than later. Maybe this workshop will give you a little bit of a nudge, to get some help. But because I mean, there's not a client I met who hasn't said, "I wish I would have started sooner." So today is your sooner. Someone's officially telling you, please start today. It's never too late. Or what if you're already started, please have it reviewed. Make sure you're on the right track. Please review this on a regular basis. Planning, investing, having investments is not a plan. Having an insurance policy is not a plan. Having a 401k is not a plan. Those are assets that all feed into a bigger plan. So when people get to close and they say, well, here's what I was hoping for. I was hoping that if you have someone they have family, I was hoping that we can retire and it would be great if we can just continue to grow that money and then leave it to our kids or charity. That would be ideal, right? Hard to do because you really need a pile of capital and you need to make sure you behave yourself financially, make sure you don't make rash decisions, and make sure you keep your spending to moderate. People want to maintain their standard of living, and that's what we strive for when we do plans. And that's what we focus on, maintaining their standard of living. The truth is sometimes people have to modify that if they're not prepared. But most people want to increase wealth into financial independence. Well, but most everyone will settle for this. They say, well, if I could just keep my accounts the same, you probably recognize this feeling either for yourself or your parents. But if I could just keep my money the same and just draw from that, that would be great. That way I'd, kind of like feel like I've got control of it and I'm not really using the money that I've earned. That would be ideal for most people. Some people say, hey, and you've heard this before, I want to go ahead. Thank you, Jim. I'm going to get to your question in a sec. I want to go ahead and spend it down to the last dollar so that the last check I write bounces. Well, people don't write checks anymore, right? But I understand the feeling, and that's a pretty exciting thought. There actually are books that are written for that, how to bounce your last check. But the fact is that nobody really knows when their last check is going to be written because they don't know exactly when they're going to die. So that's really kind of tough, and we normally don't try to plan for that. Um, so that's what the three outcomes are. And so now we're gonna go into some assets that'll help you preserve the one in the center. Jim is asking, what are the benefits of passing commissions through S corps, C corps, LLCs? What about employer matching if we're the sole member of that corporation? A couple of things. There are so C Corp for folks, and I'm assuming independent contractors, real estate professional realtors. So I'm going to make that assumption. So based on that, C Corps aren't used very much anymore. They're used for some real estate transactions that are a little more complex. A C Corp could be very good for buying long-term care insurance, by the way, when you're working, because if you have a C Corp, if you buy long-term care insurance, you can actually write off those premiums to the company, do it big payments for just 10 years and be done with it. So if you think about long-term care and you have the flexibility to open up a C corp along with your S corp or whatever else you've got going on, that could be a good reason all by itself. I've had people do that to buy long-term care for themselves and their spouses. Really cool idea. Otherwise, most everyone in our profession is in a S corp or an LLC. There's not really too much of a tax difference because, and even in the C corp, it's all passed down. You normally don't leave money in a C corp and you don't get taxed. They normally pass it all the way through, and so it ends up at being at the ordinary income tax of your personal tax return. So there's not really a big advantage. I'm going to make it very simple that way. Regarding being able to employer match, you can do that under the S corp, and you can do that under the LLC. It really is not about the structure of the entity that you have. It really is about the retirement plan documents that you create, and having your third-party administrator for those documents, have them allow you to set up a profit sharing component to that so that you can, in fact, have the company pay for your match, have it come from there, and then you make your own contributions as well. That's how that works. A third-party administrator costs a little bit more money every year, but I've always seen it work out so that that little more money you pay, whether it be as little as $500 or as much as $1,200, something like that, and to be able to put in another 25 or 30 grand and save taxes on that, it normally makes total sense. Plus, they take care of the record keeping for that for you as well. Jim, I hope that helps with that question. I thank you. I appreciate you asking that question. So here are the big dividend drivers or the big income drivers for you in retirement. I'll talk about the first one, Social Security. I don't want to guarantee you this, but I want to assure you something. All of the uh, excitement that you're hearing, I don't want to take a position either way on this, in terms of one party or the other, because that's not really important. The important thing is will Social Security be here. They just announced yesterday that, in fact, the time frame for fully funding Social Security has, decreased by a year. I think we have until 2034. So, and they won't be able to fully fund it. They will be able to partially fund it at that point. That's assuming that we wait and do nothing all the way till that time. They will still be able to partially fund it. It'll probably be discounted by 25%. Yes. I've been saying this for 20 years. Greenspan, when I saw him speak 20 years ago, said the same thing that most people feel and they know, that this Social Security problem could be solved in 15, 20 minutes if you got the right people in the same room. 10 minutes of that is catching up on the family. Either 10 minutes of that is not being political, but just being focused on solving the problem. And we get politics a little, but we just can't seem to do that. So something needs to happen. I do believe this. I do believe it'll be around for everyone on the call. That's what I believe. I believe it'll be discounted. I believe it'll be taxed more. So I do believe that the value of it will be less than what we see on our statements today. But we shouldn't discount it. When I have a client that says, let's totally discount that, if they're in their 30s or in their 40s, I'll give them that scenario where we totally discount it, but also give them another scenario where we assume that 50% is going to survive. Because if we cut it by 50%, it's going to work. It's going to cause a lot of pain. But for the younger folks, it'll at least contribute something. So it'll be there. The big mistake that's being made now is, hey, I better take it now early. I was going to wait so I can get a bigger benefit. Better take it now because it might go away. It's not. I'm kind of. I can take it now, but I'm going to wait. If that tells you anything, because whatever it turns out to be, I'll get a higher amount of whatever that discount rate may be. I really don't know exactly, but I don't think it's as. I think our emotions are exceeding probably what will happen to this. So expect a discount, but expect it to be around probably for most everyone. Stocks. When people think of stocks since 1996, I've got a couple examples here. Here's a dot-com crash. Here's some 99, peaked in March 2000 and went down for 3 straight years, right? That was a tough crash. If you had small company stocks, you lost 80% of your value in 3 years. Here is, the crash of 2008, the mortgage-backed securities crash. Here is COVID, that nice increase and also that sharp drop, 34% within a couple of months. That was amazing. That was actually breathtaking. When people think of stocks, this is what they see, but this is what they should see. They should see this. This is from 96 to 2024. And I pointed out those drops. There's another one since then, 2022. But look at that chart. I mean, in the long run, going from 96 to 2024, that is a nice, healthy growth. I mean, that is, I don't see it right here easily, but that's average growth rate of about 8% a year. And by the way, the stock market, S&P 500, which is what this is, it's about 8% a year. I mean, you can break it out into 1 year, 5 year increments, but most of us will be around for 20 years, right? And it will be fine. In 20 years, things correct themselves. There's not a 20-year period here since 96 where things have gone sideways or down. It's gone up. So you need to have a little bit of faith. There's no guarantee, obviously, but everyone says this time is different. It really isn't. I mean, I think we all still think we're at a loss this year, and actually we're kind of at almost relatively new highs. Even though all this other tariff stuff and all this other the war stuff is happening, it's quite amazing. Stock market is quite resilient because people still have to buy stuff, and that's what the stocks are based on. Okay, here's bonds. Bonds could be perceived as pretty boring for some people. I have trouble getting some folks into bonds, but I want to show you this chart here. This goes back to 76. So this is a longer period of time. Now, it goes year by year. So if you see 76 on the far left-hand side right here, in 76, at one point that year, it was down negative 1%, but at one point, it was as high as 16%, right? So it gives you a range. Here's a dramatic one, 82, -2 to 33% up, right? So it gives you an idea what the range of outcomes have been. But I want you to notice something. 43 of these years ultimately were positive for the bond market. So talk about something that's definitely more stable or more certain than stock markets. But this is pretty impressive. It really shows you that when you look at the losses, they're not too bad. So bonds are a very nice way to not only generate income because you get income from bonds if you buy the right bonds. If you buy a bond family fund, you're not going to get the income there. But if you buy bonds and they're income generated, meant to generate income for you, dividends, and some of them could be tax free, you could generate anywhere between 2.5 to 4.5 to 5 or more% every single year without pulling down the principal. And one last thing I just realized regarding the SP 500 and stocks, the dividend producing stocks, if you buy the index, you're going to get a dividend of about 1.5, 1.75% a year. Not very exciting, not enough to really fund your retirement. But you consider focusing on dividend producing stocks, that dividend could be 4, 5, 6% a year. There's some funds that actually have growing dividends every year. They've got a very good track record. So if you consider the dividends on the stocks that we talked about, and then you add to the mix bonds and their dividends, and the fact that they will kind of equal out each other pretty nicely because they don't all behave the same. When one goes up, the other goes down. You probably notice that. It can be a very good relationship between the two. Real estate, here's what I like about real estate and alternative investments: diversification, higher return rates potentially, inflation hedge, because with inflation, the assets go up as well. There are unique opportunities, especially in your business. They generate income generally. Anyway, there's a lot of pluses for alternative investments. This chart is represents kind of what I was saying regarding income again. Now, this is a global private real estate returns. Now, you can buy these REITs if you want, but if you look at real estate globally, and I'm talking about commercial real estate here, you can see from 96, if you look at the blue right here, 90 from 96 to 2024, this is the asset value back in '09 and 10 because of the mortgage-backed securities. The markets were bad for a while, so it went down as low as 22%. And then market values, look at the blue, went back up again. Now the favorable are positive, having a good time, back down with COVID, back up quickly again, back down recently with interest rates and so on. So the market values of real estate, they go up and down. But if you hold real estate for the dividends, this area right here, this gray area, that's all income. And I want you to notice that even though real estate has gone up or down in terms of value, the income is still generated. And that is really the impact of real estate in a portfolio, is that if you buy that asset correctly, or you're in a fund that has a good strategy and buys assets that generate income, this could be the experience you have. 5, 7%, 6% here, drops a little bit, nice and stable. So add that to the stocks and bonds, and you have a pretty good mix. Now, um, I'm gonna make quick work of this here. I'm gonna go back to the very last one here. Let's assume somebody right here they had 80% stocks and 20% bonds. Well, if they added 30% alternatives, it's not a recommended go out and do this today. It's someone to pay attention to, though. It's one to realize, hey, this is what it could be. But if they added 30% alternatives, which includes real estate, right? Then all of a sudden their return rate here, I mean, if you look at this chart here, and I know this is this is risk right here, right down here. So we want a lower number. We don't want higher risk. We want low risk. Well, here's returns right here from 6 to 10%. We'd rather be over here, right? That's where we want to be. Now check this out. When they go from 80% stocks and bonds and 20% bonds to adding 30% alternative investments, their return rate stays the same. The return rate, in fact, I'll show you right here, is 9.6%, which is pretty substantial right here. That's a nice average. But what I want you to know is that their risk rate drops down by at least 40%. Their risk on their portfolio drops considerably by adding alternatives. So having the three together, the stocks, bonds, and real estate together, can really do a benefit to your portfolio. We're going to wind up here pretty soon. Here's another form of income, and I talked about annuities here in that one bubble. Annuities can be great. First of all, there's some people like Fisher Investments that don't like them because they don't do it, so they bash them all they can. But more and more advisors are recommending more and more annuities, and annuities are continue to grow as a place that people invest. They offer tax deferral. They can offer loss of protection. They can guarantee that you won't lose income or asset value while you're alive. It could be like a pension. So you have Social Security and you have an annuity, and they could both be producing income. And by producing that income, it actually reduces your chance of failure for financial independence. So they have pension-like qualities. And they also have survivor benefits. Not all annuities are like this. In fact, annuities are all over the place. There's some lousy annuities out there, but there's also some very good annuities too. So keep an eye out for that. Keep an open mind for that. I know some of you do, some of the advisors who get paid on not selling annuities, they will tell you otherwise. I will add one last thing around the insurance area here. Long-term care insurance, something you should think about. It's a growing problem. We can't, to qualify for Medicaid, you have to really spend on your assets. That's not the goal of this workshop here, to help you spend on your assets. So think about how you're going to mitigate that risk. And insurance is one way to do that. So winding up this way to reach financial independence, hope is not a strategy. Hoping that things will come together at the very end and work out well is not a strategy. Like I said, most people want to wish they could have planned earlier. They just didn't have the time or the patience, perhaps, or the sort of help. Planning is a strategy, though. Here's a client that we came across in the San Francisco Bay Area. We're in Colorado, but we have clients all over the country. And here's one in California. They came to us with some pretty good assets, 1.5 million here, plus they have their home, plus a rental property. So this includes a rental property. We did a forecast of their finances, and this is just give you an idea of how this chart works. This is the far left is current age. The far right is life expectancy. We had them go out to 95. And then the estimated market value, like I said, the people want to go, people want, and here they are, they're got all their hopes and dreams in your hands, and they're ready to help them. And things can go one of three ways. They can either grow over time, they leave more for their kids, they can stay flat, which is kind of acceptable, or maybe they want to get aggressive and spend the last dollar, which, is hard to plan for. But here's what happened to them. We looked at their current holdings and they did such a good job, but they were going to run out of money in their 80s. Their assets were going down. At that point, they still had their real estate. But at that point in their mid 80s, 84, they were they were targeted to living in a van down by the river. The old I think it's Chris Farley, right? So it wasn't looking good. And there's several things actually. This is the same client that had the notes. When we actually did the notes, put them in an IRA account instead of their taxable area, it actually improved their position by a couple $100,000. So that helped. But all by itself, the rental property they had wasn't producing as much as they thought it could. Um, so they would sell the rental, then they would sell the home. That's what actually would make that work. But that's not the plan they wanted. So we said, what if we exchanged it into something that was just a 5% return rate? So that's not a big ask. It's not like we're hoping, for the moon. And by doing that scenario for them, and by assuming that we looked at a replacement, an exchange, 1030 exchange that had 5%, their finances looked amazing. So the blue is the old line, the green is the contribution or the benefits of changing from the very first year the cash flow helped. And they ended up with, and the difference was over $4 million of net worth. Now they had about in the very beginning, probably $3.5 million net worth. This is in the future, by the way, going forward. So you size it however you want, but if I take a look at somebody who had a rental property of that was worth $500,000, it would be a difference of about $1 million. That's what that looks like for them. Uh, but that's one of several things um, that helped improve. It wasn't just that all by itself. Hey, what if they just said, we can't find a rental or we're tired of being renters or owners? What if they just pay the taxes? That's another scenario. Well, we did that one too, and they didn't come out as well, but they came out pretty darn good. It actually paying the taxes compared to not paying the taxes is different. The difference long term was about $1 million in total net worth when they finally the second of them passed, but it was still a positive outcome. Something that they didn't see because they had no idea exactly how to review their real estate investments. So that's an example. Here's an idea of what the team looks like for you. A certified financial planner is a great start, and that's what I am. Again, feel free to reach out to me if you'd like to talk. An investment advisor, insurance advisor, somebody who just focuses on those things. The right insurance advisor would be nice. Sometimes hard to get. Tax pro, especially in your business, a small business tax professional would be ideal. Somebody who maybe knows about real estate too could be a resource for your clients. Estate planning attorney, very important. Half of Probably half of you on this call have some sort of estate planning done. And of those that do, half of them are outdated. So very big idea, especially when you're thinking about your grandparents or your parents' estate and settling all that stuff and how messy it got. It probably could have gotten simpler. And then finally, trusted representatives, custodians that you choose, people in your life that'll help you execute this. That's it. That's what I look like on a good day. And here's a chart that I will add. This is something we didn't get through. And here's that other chart I mentioned that I would add to. Okay, folks, we are almost on time. I want to encourage you to ask any questions you have at this point. Let me go ahead and stop sharing. Okay. Anything we can cover before we go today? Well, let me go ahead and drop this in here into chat, contact information. If you have any other questions afterwards or have something private, feel free to reach out. Melissa, I think that we are substantially done here.
We are. Thank you for this today. You've been great. We appreciate you lending your time and your expertise to all of our members today. As Rich said, if you have any questions, please reach out to him. His information is there in the chat. We have recorded this webinar and I'm going to be sending that out to you within the next day or so. As we also will be sending a copy of the slides for you if you want to go back and refer to those as well. So with that, I say thank you to everybody for joining us. Rich, again, thank you to you for your time and expertise, and have a good afternoon, everyone.
My pleasure. Thank you.